game. I was taking trips to the left coast with the bows, just trying to make a name. I thought I was on the right path till the troll got behind me and hit the lights. Pack touchdown in Gainesville like I'm Percy, telling me that I'm more handsome in person. I been found my purpose, can't pop me no perky. I tapped in some shit you can't reach it like cursive. I'm tapping some shit you can't see to believe in. Some shit you can't see to believe in. OG on trap on Sunday like a deacon.
For this disaster.
Schauen Sie.
Well,
Rückwärts zu
look,
schauen ist immer einfach.
hindsight is wonderful,
Es ist einfach eine
and to point a finger, it's a fact
sicherlich seit
that
2021 mit Green
since 2021 with JADOS, we never left the headlines. We were overtaken by legacy situations, by risks that materialized last year. We were affected by a market model that does no longer work in this market environment, and many clients have been very loyal for a very long time. And last autumn, we had this social media storm, and this had huge repercussions. More in the retail sector than in the wholesale sector, and too much becomes too much. And that's when we reach this point. It's accumulation of various facts that contributed to one another and then materialized at some point. And this then caused the situation to deteriorate.
Bitcoin went up today, and I could argue that now it can't even be held in banks. Bitcoin's a strange animal. I will say point blank, I think it's being manipulated up. It was being manipulated the whole time by Sam Bankman-Fried. So please don't assume, therefore, that it's not still being manipulated. And I would sell my Bitcoin right into this rally. And believe me, I had been a believer one time in Bitcoin. Not here, not now.
Look, this was not the best solution, but it dominated the other two, which was either nationalization or trying to wind down the bank. But it's full of contradictions. You spoke about AT1 versus equity. It's a private sector solution, but has government intervention. You know, it's not clean, but of the available options, this was the best one that they could have had.
Mohammed, was this a bailout?
Yeah, it was a bailout. There's $9 billion of contingency credit guarantees there. There's $100 billion of liquidity support. Yeah, it was a bailout. But, you know, bailouts, the phrase bailout has become such an awful phrase that everybody's avoiding it. They're going out of their way to say it's not a bailout, but then they can't explain why money is being put to work. Yeah, it is a bailout, and it's a bailout, and you heard the minister say, it's a bailout because they're dealing with a systemically important bank at a time of market turmoil.
Moses Ventures. Danny, there's so much to unpack here with you that I want to get to. But first, I mean, I'm just curious what you think of this bank bounce, and are you finding any shorts or longs in this sector at this point?
I'm kind of taking it all in here. A lot has gone on, obviously, in the last week. A week ago, no one even knew, or some people knew this might happen, but this kind of new. So it's hard to really buy or sell securities, or stocks that is, not knowing how the plan's going to be unveiled. And we're getting a little bit more clarity on that in terms of this BTFP, which they could have called BTFD, obviously, if you know what I mean, in terms of what they're going to be providing. And so the problem here, though, is really sifting through. It's not just about agency securities and treasuries. There's commercial loans that are on banks' balance sheets, commercial real estate, right, C&I loans, et cetera, that are still going to be a problem. And I think now's the time to really dig in to these banks. So,
yeah, I mean, there's a lot of work to be done. I mean, to think that people whose sole living is to analyze these banks, whether it be Wall Street analysts, ratings agencies, San Francisco Fed, regulate, you name it, they all missed the boat on this. So for all of us here out here, you know, there is a lot of work to be done. In terms of, though, guaranteeing all deposits, does that make anything safer in your view? If this became the norm, if this became the rule, that there is a backstop for everything, does that make the sector any more attractive in your view? Stabilize things?
No, I think that should scare people, the fact that the regulators think that they need to go out and actually do that. And so now I think what we're going to see is the banks that maybe come to this window and use this program is going to raise a lot of questions. And you can't assume that the regulators have any idea what they're actually dealing with now, considering that they were completely caught off guard, it appears, by what just happened at Silicon Valley Bank. So that should make people nervous. But again, you know, the first earnings out of the gate that we get for Q1 are the banks. So we're going to see a lot of interesting information come out. So we're definitely not out of the woods. And I think the Fed is kidding themselves if they think that this situation is just going to go away. I think a lot more people will come to this new window, so to speak, to deliver some of these assets.
Hey, Danny, Tim. So let's get to, you know, I feel like the Fed and the dollar and even rates were kind of the previews, and we're now at the matinee. I mean, it's credit time. And to me, we may have peaked on Fed. We may have peaked on dollar. We may have peaked on rates. This is generally a great time for owning equities, but we've just gotten a glimpse of what goes on in credit. How are you playing that? How do you view credit spreads here? We went up a full 1% in about a week on high-yield OAS. I realize it's not, you know, at extreme levels, but everybody says there's no credit dynamic working right now. I'm not sure I agree.
There's been a credit dynamic in place since the Fed started raising rates. We're just now getting the lag impact of that. Look back in the last fall when Blackstone had to gate their funds, when Starwood had to gate their funds. That's really on the commercial real estate side of thing that's been occurring. You had two defaults already, right? PIMCO, Brookfield already, you know, defaulting on office buildings. These
credit. How are you playing that? How do you view credit spreads here? We went up a full 1% in about a week on high-yield OAS. I realize it's not, you know, at extreme levels, but everybody says there's no credit dynamic working right now. I'm not sure I agree.
There's been a credit dynamic in place since the Fed started raising rates. We're just now getting the lag impact of that. Look back in the last fall when Blackstone had to gate their funds, when Starwood had to gate their funds. That's really on the commercial real estate side of thing that's been occurring. You had two defaults already, right? PIMCO, Brookfield already, you know, defaulting on office buildings. These things have already been in motion. And this is what I mean about, okay, we didn't see this coming a week ago, or 99% of people did not see this coming. So now it's the all clear. I don't think so. To your point, Tim, you made earlier on the show about cost of capital moving higher, rest assured that banks now will be forced to have more capital. And like it or not, the big banks are about to get bigger. And it's been happening in real time as we're sitting here. It's probably happening right now. And so that is not what the regulators wanted to see. But to your point, it doesn't change anything. What it did was it basically moved the Fed from a terminal rate or market expectations from almost it had gotten high as 6% here, really to 5%. And now at the end of the year, I'm looking on CME and Fed fund futures are at 4% at year end. So what we did was we got the relief rally associated with the Fed stopping. But the truth is, the aftermath of this, I think actually the economy, if you believe it's going to slow down, it just accelerated that slowdown because banks have to really pull back in their activities.
Danny, so, you know, the saying is the Fed keeps going until something breaks. Was this it?
I think this was a small vase sitting on the window. So again, you know, what I really think is in terms of breaking, obviously this wasn't on a lot of people's bingo cards, right? It was on certain people that have been actively shorting some of these names that saw this balance sheet that had massive issues. So I just really feel like we still have underestimated in this market in general what is happening when you raise rates 4.5% and what may end up being 5%. We'll see what the Fed does next week. Maybe it's another quarter point. And the other thing, Melissa, is this whole QT, quantitative tightening that's been going on. Great job. We got it down from $9 trillion to $8.4 trillion. I think we can safely say that QT is probably done here, and we're back in somewhat of a QE, at least a neutral mode. So we got some stuff done, but the problem here is we still have inflation, and I believe that you are now brought forward the potential for stagflation as a result, because the Fed still has to do their job, because what you don't want to see is them to stop while inflation is still running hot.
Yeah, it's a tough choice. Financial stability versus price stability. It's a tough one. Danny, it's always great to speak with you. Thank you so much. Danny Moses. Let's bring in Danny Moses of the
Yeah, that's me. Who happened to have some of his startup capital lodged in that bank?
Ken, a lot of people don't know this, has a winery like Gavin Newsome, and he was banking with SVB.
Well, congratulations. I'm glad that everything worked out for you.
You know me, I like to support the innovators.
That's right, yes. So Gavin Newsome loves to support the innovators as well. Tell us a little bit about his entanglements with Silicon Valley Bank, what we know of them.
Yeah, so it turns out he has 3 wineries. He was a businessman before becoming governor, owns a bunch of companies in the hospitality industry, and 3 of those wineries appeared in the bank's winery division. That's a thing for the bank, and it's listed on the website. And so it turns out he uses Silicon Valley Bank for those three companies. In addition to that, a longtime former employee of Newsome's told me that he also uses it for his personal, he has multiple personal accounts with the bank as well. And then a third angle to all of this is that his wife runs a nonprofit and on the board of directors is a president of Silicon Valley Bank. And that nonprofit received $100,000 from SVB over the last several years. So a number of different points of connection and ties between Governor Newsom and that bank.
And I want to get your thoughts, Ken, on the response from Newsom's camp to your reporting. They claim, right, that he has his holdings, all of his financial holdings are in a blind trust. What do we know about the potential conflicts there and how much that would matter if, for instance, his wife has this connection on the board with SVB?
Right. So the problem with this blind trust is that it's not meaningfully blind if you look at what some of the ethics experts have said. And what this case is really reminiscent of was President Trump and his attempt to put his companies into a blind trust, which he then allowed his son to run. And then in this case, sort of in parallel to that, Governor Newsom's sister runs his blind trust. And so the critique of that is that it's not meaningfully blind because A, he already knows all the companies that's in it because he's run them for a number of years. And B, it's his blood relative that's running this thing. So what kind of wall is that to put between him and these firms?
It occurred to me another good one is Joe Manchin, who he and his wife have a coal company, and they put it in the name. They put it in a blind trust, but his son runs it, but he still knows it's a coal company.
Right.
He knows what it does. Right. And now Newsom might only be able to assume at this point that the winery still has accounts with Silicon Valley Bank, but you don't typically, move your major banking operations for no reason unless you're a tech bro kind of trying to spark a panic or you're panicked. I was actually just looking up his wine. Plump Jack is one of his wineries. Apparently, it specializes. It's a boutique, like Northern California Cabernets. It's $100 a bottle for their 2018 Plump Jack. You ever had Plump Jack Cabernet?
I've not.
Never heard of it. Have you ever heard of it?
No.
Anyway,
but I'm not a big Cabernet person.
And so, did you get any reaction from either the California press or the governor's office from this story? What did you hear?
Yeah, the California press is actually following up on it, and I'm glad that it hasn't just become a partisan football because this is really, as I said with the Trump case, this is an ethics question that is a serious one and has been a serious one in the local press. They had looked at these problems, not specifically the wine companies and the bank, but all of his holdings. And this is something that comes up anytime you have one of these business moguls that has a high net worth as Governor Newsom does. There are all these questions of conflicts of interest. And so there's been some very good reporting in the local press around what's called behested giving. So there are strict limits on what California politicians can take in terms of gifts generally, but there's one exception, and that is what's called behested giving, where the politician directs giving to something. And in this case, Newsom is known to have directed giving to his wife's nonprofit, and so it's not regulated in the same fashion that other gifts are, and that's something that the local press has been focusing on for a number of years now.
And Ken, you just said something important, which is that you didn't want it to become sort of a partisan football. The report you had just before this one was about entanglements in the office of Kevin McCarthy with Silicon Valley Bank. Tell us about what you found there.
Yeah, what was interesting about that is that two of the House Speaker McCarthy's senior staffers for a number of years ended up becoming registered lobbyists for Silicon Valley Bank. And not just that, when I looked at what specifically they lobbied on, it's directly related to all the stuff that's happening now, which is the 2018 Dodd-Frank partial rollback, specifically pushed on that, lobbied the FDIC, which is what's ensuring the depositors at this point and guaranteeing making whole the people that had money in that bank. So it's directly connected to all this. And what's sort of funny about that is when I have this Newsome piece come out, some Democrats are very angry about it, saying, oh, you're a Republican disguise. It's like, oh, that's funny. You missed my last story. It's literally about the other. I'm not looking for any specific. I'm just looking at the bank and trying to see where the nexus is with politicians, and whatever pops up is what I'm going to write about. So I don't know what to tell people.
Yeah, and it's really in that rule writing and in the regulatory side where the public is at the most disadvantage. So in Congress, at least it's happening somewhat in public view, so people can weigh in when it's an obscure kind of rollback. Unless you're reading The Intercept, The American Prospect, you're not going to follow those repeal efforts through Congress, but you can if you want to. by the time it gets into the FDIC, it's really like former McCarthy aides, former Manchin aides, former House Financial Services Committee aides who are going directly to the FDIC saying, all right, so here is what was written into law. Now here's how we can weaken it even further. Because the FDIC, aside from insuring deposits, also wrote a lot of the rules around Dodd-Frank about how are we going to implement the law? What does it mean when we're going to stress test you? How often are we going to look at your books? What do we feel like is a reasonable amount of exposure? What is not a reasonable amount of exposure? Because what I think a lot of people might not understand is the direct link between the 2018 rollback and this blowup. The link would be if there were tighter inspections and stress tests of the bank, you might have had regulators come in and say, all of these bond holdings, these mortgage-backed securities, I've been hearing a lot on the news about potential coming interest rate hikes. Mm-hmm. I'm not sure that if that stressor hits you, that you're going to be able to survive that. So one of two things happens. They make them unwind those, or knowing that they're going to get that pressure from regulators, the risk managers don't do it. They say, you know what, we need shorter-term bonds here, or we just need to stay in treasuries, or we need to make sure we're tightly hedged in the case of some type of shock from interest rates. And this idea that nobody could see these interest hikes coming, are you kidding me? I'm not a risk manager at a bank. I knew they were going to raise interest rates.
I talked to an employee of SVB Bank who himself was frustrated about exactly what you're saying, which is that, of course, they were going to raise.
They were saying it.
And so what's amazing, I interviewed an economist recently about all this and said, why are these banks so adamant about rolling back regulations? Because doesn't that end up hurting them in the mid to long term? And he's like, well, you're assuming that they're looking at the mid to long term, Because again, talking to this employee, he would have been happy to have the stress test happen because he wouldn't have to worry about all this stuff now that he's having to brief investors and things on and hope for his job to still exist in a year. And so it's kind of interesting how much it ends up hurting basically everyone except people at the very top C-suite level, these kind of deregulations.
Well, and you quote at the very end, you really stick the landing in this piece, Ken. You say, perhaps no one embodied this contradiction more than Larry Summers, who said, this is not the time for moral hazard lectures or for lessons administering or for alarm about the political consequences of bailouts, from a tweet on Sunday. And when you have, to your point about the people in the C-suites never ending up getting hurt, well, maybe that's partially why.
Yeah, coming from the guy that for the last 2 years has been endlessly talking about how we can't have student loan debt because the moral hazard, and now, whoa, we don't have to worry about moral hazard. This is a very serious issue right now.
Yeah.
Right.
All those
like,
and that we need more unemployed people. That's the other thing. He said we need 5%
he said we need more
unemployment for 10 years.
What happened to that?
Yeah.
Well, here's your chance, right?
Right. But not like that.
The wrong people would be unemployed.
We don't want them to be unemployed. Right. Come on now. That's a little bit. Those guys? No, I know them.
Yeah, they're my friends.
Yeah.
They need
good people.
But
they have wineries.
That's how you know somebody has lost an argument, when they just say, now is not the time.
Yeah, now is.
Okay,
a memoir
you might be
by
right.
Ken
You might be right. I just don't want to hear it right now.
Ken, great report.